We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro. We are glad to have you on our podcast, or if you're watching on YouTube, our YouTube channel, we are glad to have you. Today we are here with Christopher Nelson, Wealthword Capital. And he is here to tell us all about where he's been, how he got his sights set on real estate, and where he's headed. So, Christopher, how are you today?
Casey, I am doing phenomenal because I am here talking to people that are pursuing cash flow, and that's what I love to talk about.
Absolutely, man. Well, we're certainly glad to have you, and we want to, we want to hear all about your adventures, and then, of course, we and I were talking a little bit before the show about how, you kind of decided to say, hey, I didn't want just inflation chewing up my money, so I started to set my sights on things I could do to generate cash flow. So, man, if you want to kind of take us back throughout, kind of when you got started in your maybe professional life in general, and then what kind of maybe geared you towards saying, hey, I need to invest in some of this passive income stuff.
Well, I'll tell you, it did start with, I think many people started with Rich Dad, Poor Dad, right? So I read it when I was in college in the late 90s, and I thought, okay, I want to be able to get money working for me when I sleep. Like, I had that always as my goal, but there's no roadmap. There's no sort of quick and easy button to get there. So graduating with a degree in a technology field, I started working right away for a very large company, and I gained a lot of skills. And I saw a lot of my peers were actually leaving at the time and going to work for these startup companies. And I was starting to see them go through, some of them were going through IPOs and getting this, sort of pile of cash. And I thought to myself, if I could do that, I could get this mountain of cash, and then I could go figure out this whole real estate, this whole cash flow thing. And so after a 10-year career in technology consulting where I built up some great skills, I headed off to go conquer the, startup world. And my first one, abject failure. I chose poorly. And instead of, having this mountain of cash, I ended up, nursing an ulcer a year later, working for a bad boss with a company going nowhere. And so,
I'm sure.
Yeah. And so I had to take a pause, and I had to retreat, and I had to just really analyze and say, how did I select this company? What was I doing? And what I realized, Casey, is that the same lens that makes you a great investor of money will also make you a great investor of your time and your talent. So that's when I actually went back to Kiyosaki, and I realized, well, wait a second. He's right in the sense that I want to be able to be an owner of a company. And working in technology, I have the ability to trade my time and talent for equity, be a part owner. But I have to think like an investor. So I put together a due diligence criteria. I did some risk analysis. And what I realized is that I didn't want to go work for this early stage startup or some sort of opportunistic deal. I wanted to actually go work for a value add. I wanted to try to find a company that was, 12 to 18 months away from an IPO, close to the exit. I understood what that looked like. So then when I actually made my second choice within 11 months, I had a multiple seven-figure payday.
Well, man, and that's got to be one of those life-changing decisions, I guess, right?
Yeah. And it was a life-changing decision. And, it was one of those things that I, was working towards it. But then all of a sudden when it happens, and you have this day when all of a sudden on paper in the market, you have this now, much larger net worth than I ever had in my life previously.
Sure.
It also brings in a flood of emotions. What a lot of people don't realize is that there's a sudden wealth syndrome that actually creates anxiety, creates depression, creates a feeling of isolation because of the fact you don't know who to talk to, you don't know
Yep.
what to do, and so you are overwhelmed with this fear of I don't want to be that idiot.
Well, you certainly don't know who to trust, I'm sure. I mean, you hate to be discussing cash flow and talking about lottery winners, or
Right?
investing and talking about lottery winners, but they made a whole TV show about that stuff.
Right?
And the sudden wealth of, and I remember one guy ended up getting himself killed because he didn't have a clue. He didn't have a clue that there was people who were going to try. And of course, we're talking extremes. I mean, I
Sure,
don't want
sure.
to act like, but sudden wealth syndrome. I've never actually heard it. I've never actually heard it called
Yeah.
that. It's
I mean,
just
it's the same thing that happens to, football players, on draft day,
sure,
right? All of a sudden
sure.
nothing and then boom, millions. And so, what what my wife and I did is we took a pause, and our next thing that we did sort of in sort of life was just let's get educated. So we really
Yeah.
started cracking the books, really started, understanding, taking courses. We wanted to understand the math behind real estate. We wanted to understand the details, started getting to know people, and we weren't making any moves. Our investment was first and foremost in ourselves and really understanding it. And at that
Yeah.
point, we were living in the Bay Area, so we started doing some, crowdfunding again, where we could put in, $5,000, $10,000, things that we didn't mind putting at risk, but we had skin in the game, and then we could monitor and manage it and see how our performance was doing. And it was really a move to Austin, Texas, that then really opened up the real estate world for us.
Wow. And what year was that?
So we moved here in 2017.
Okay, so really just because like it's like everybody talks about the Beatles and Austin. I mean, it's like now
Yeah,
as far as today's time, I'm like everything. Austin is the coolest thing ever. It's the coolest
that's
place to
right.
be, and like you're nothing if you don't if you don't either invest or own or know somebody that lives in Austin that's in real estate. It's just and I remember when I was a kid, and I talk back in like and I hate to just dive right into Austin, but I just mean,
Sure.
when I was a kid, I mean, Austin was like where I knew some people's grandparents that lived there or something. I mean, it
Right.
was just, it wasn't necessarily off the beaten path because it's always, it's the capital, right? I'm trying to,
Sure.
yeah, the capital of Texas. And so it was just not, but now it's like the hip, cool,
Oh
I don't
yeah.
know. So anyway, and like you hear guys rapping about going to Austin, Texas. It's like, really? Anyway,
I haven't heard that. You'll have to share.
so, but so the move to Austin opened up just like completely like opened up what was already kind of there, and
It
just
made
like
it accessible, Casey, because what it was is when you're living in a high cost of living area, when you're living in the Bay Area where,
oh
you think, okay, $1 million homes, there's no cash flow. How am I going to buy this? You wouldn't syndicate that. It's truly, a billionaire's game. You come here to Texas and, you go to meetups and people are buying, buildings that you can walk and see and we can touch and feel. We're like, wait a
sure,
second, this is where we need to be. In 2017, people thought that that was sort of the end of the cycle, but as we know now, that was really sort of the beginning of, this catapult of 17, 18, 19, 20 was a little weird, but then 21
yep,
went even further. So, we started participating as limited partners and, making some more investments. And that's when everything changed for me because as I was sharing what I was doing with, you know, coworkers and friends back in the Bay Area who are
yeah,
technology executives, technology employees, high net worth, a lot of exposure to the stock market or, venture investments, which again are very illiquid, no cash flow, looking for equity multiples.
yep,
They said, we need income in our portfolio. We need cash flow. They saw us starting to build up, and I was just so excited. I'm like, we're getting cash flow. At that point,
yeah,
you're getting off of multifamily, you could get, 11%, 10%, 9, 8, etc. And
sure,
so it was phenomenal. And so this is where, Wealthword Capital was born in 2017, where, I started pooling some capital and partnering with operators here to, help syndicate multifamily apartments. And, And then we grew from Austin to Dallas and San Antonio, and that's where we built a portfolio of 3,000 units and roughly around 300 million in
Jeez.
value.
Golly. I mean, and that's, and you syndicated all of that?
That's right.
Oh my gosh, 3,000 doors. That's unbelievable. And now, so Austin, Dallas, and San Antonio. I mean, you're in like the coolest areas of Texas all around. Now, of course, we talk so much and we hear so much about investing in coming. You said you came from the Bay Area, so I want to
Yeah,
kind of go back there just a little bit.
sure.
We hear so much talk about not investing in California and New York, basically.
Hmm.
And I don't mean to just throw those two under the bus because I know there's
Sure.
some other little areas where that aren't the best in the world either. But a guy was telling me the other day. He was on my podcast. As a matter of fact, we were talking about note buying. He was buying
Mm,
notes.
yeah.
He was buying first mortgages that were uh, they were people that were behind or troubled or
Oh,
whatever,
wow. Yeah.
and so he said he doesn't buy in Texas because the notes are too high, they're too expensive, and
Interesting.
part of the reason why they're too expensive is because it's like foreclosure and eviction or whatever is really easy. Like, I don't say really easy, but it's certainly
Yeah.
easier and shorter time period than, like he said, in New York or California, 3 years. It takes you three
Yeah.
years to get possession of a property that somebody hadn't made payments on.
Right.
Or and then of course then you own something over there too. So when like I'm struggling to figure the advantages of investing over there. And you made a comment there a minute ago. You said it's a billionaire's game,
Yeah.
and I'm assuming that that's meaning that the returns are steadier, or they're able to. I mean, I'm just wondering what would make that a billionaire's game versus than being in Texas, where obviously Texas is decent cash flow, no rent control.
Mm,
Um, Evict somebody pretty quick and move
sure.
them on down the road, and if they're not paying. So I guess I just did you ever see advantages, or looking back, do you see advantages to why somebody would invest in California?
Well, I mean, I can just tell you my experience of owning a home there. I mean, we owned a home there. We purchased a home in 2013. 2,000 square foot, four bedroom, two bath for 1.3 million. We
Okay.
sold it 3 years later for $2 million. So what I'm saying is like, but this is where I say it's a billionaire's game, because billionaires are going to be diversified. They're going to be looking at different
Sure.
plays, and we know right now that there are, billionaires that own home that are renting them. They're renting them for a loss because they realize that that upside that they're going to get is going to be worth it. But they have
On
different
the
strategies.
value of the property going up versus
Yeah,
just the cash flow. Okay.
100%. And so that's where, to me, this is where, my lens has changed. And I realized everyone investment's profile can be different depending on what they need. And so I think for us that aren't billionaires, those of us who actually want also real income in our portfolio, that don't have piles of money that we can burn down while others are growing at a
Sure.
different rate,
Sure.
we need cash flow. And so that's where,
So you're
that's why I'm,
saying that those folks are able to buy more for, because there's always that argument of cash flow or appreciation, and
sure.
of course I always say it's the guy that has 300,000 in his bank account losing 100,000 is pretty detrimental. The guy that's got $3 million in his bank account and he loses 100,000. Obviously, he doesn't want to lose it, but I'm just saying
Yeah.
so the risk. But has there ever been a risk really to owning real estate, even in California? I mean, from an upside potential, and I was going through this with somebody the other day where he was talking about he owned some property in '05 and then sold it in '06 for some big money, and then of course we look back now. If you were trying to sell in '08, you were not very smart. If you
Right.
have in '05 and you're still holding on to it today, you're a genius.
That's right.
So the appreciation game, you hear that argument all the time: cash flow, appreciation, and sometimes we try to combine both. But I just don't know that California has ever, in the big scheme of things, when you look at the graph, lost money. Have they?
Ooh, I think they have. Like, I think in different dips. Like, I definitely know people that, or know of people that had done some of those purchases. Let's say 2005, 6, 7, where then they got
Yeah.
maybe sort of overextended on a mortgage, and then they lost on that because there was a dip at that point in time, and then the people who bought the dip crushed it. So there
Yeah.
has been some dips in California, but I think if you have a mentality of a long-term buy and hold, and the interesting thing, like what many people don't understand, is that the majority of the people that are buying their homes, like let's say in the Bay Area, where it's so people like the home prices are crazy, and the reality is,
Yeah.
if you're buying when we bought a home for $1.3 million, we put down $700,000, that again was come from tech equity. But many people have a ton of equity in their home. So this is where, that all of a sudden sets a price point where it's not like everyone has 100 grand in their home and the rest is levered. So then it's going to be floating based on the
So
value.
yeah.
And
Okay.
so
So you're talking about they've got some room to potentially lose. And of course, I know that a lot of times when you're in the tech industry and when you're, if you're moving around, especially moving around between companies, a lot of times those companies sometimes will have an REO company or whatever, and it's
sure.
almost like some of that losses are absorbed or something. It seems like
There's definitely
every
ways that,
situation is different. And
yeah, you get part of your packages. I mean, I know this is
yeah,
having traveled as a technology executive, right? Is part of your package will, be a buffer for some of those things. But at the end of
sure,
the day, I mean, getting back to your thing, Casey, is appreciation versus cash flow. I think everyone needs to just ask themselves, like, do they have the income that can more than cover their bills and help out with their lifestyle so
yeah,
that they don't have to be in a W-2 job or be at risk? I think that's
yeah,
truly, what I talk about with my investors, because even I know people that have $10 million net worth, but they can't stop working because they're have so much in this appreciation play that
yep,
they have no income. And this is the whole
yep,
thing, is when you think about going back to the billionaire, if you look at, and I always look at Tiger 21, right, which is that group of investors, 10 million net worth or more. If you look at their portfolio, half of it is going to be in real estate that they owned or in private equity, where they're going to be getting cash flow. And if you imagine that it's let's say a $10 million portfolio, 5 million, let's say they're getting a 10% return, just for easy math. That means they're getting 500 grand a year in cash flow. They can let all the other stuff grow because they have a backstop. And this is what I'm trying to teach people, especially in the tech industry, who may have the $1, $2, $3 million, is you need to take half of that and get some real income. Bond
sure,
market's not there. Dividend stocks aren't going to do it. You have to go to old school real estate and get some serious passive income, so that then you can take a sabbatical. You can downshift in your career. Maybe you don't need to make 150 grand a year. Maybe you just need to make 50 grand a year because you got a backstop. And that's
yeah, yeah,
really
yeah.
what I'm trying to show people how to do.
Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show.
The thing is that if you can take the years, especially, and I say especially in the tech industry or the tech business, because those are typically higher paying jobs, certainly that
Yeah.
where, I don't want to say they're, but sometimes they're higher cost of living areas as well. And
Yep.
so some of that balance, but you take these chunks and you set them into private equity or wherever you want, like some kind of a cash flow business. Well, then, you take those chunks that you've made, and then it might let you ease up some later on and
Oh yeah.
keep the same continuity when it comes to the income. So it's really smart, and especially with I don't know, people that are system minded. I mean, I guess I'm a system minded person
Yeah.
where I just want to like, you want to be, and you want things to be reliable where,
Yep.
next month you're going to get X number of dollars, and then you can kind of set your budget from there. Now,
That's right.
because, for instance, like the real estate sales business, I know my listeners probably get tired of hearing me talk about the real estate sales business, but you know, you make $50,000 commission. Okay, that's wonderful. I mean,
Yeah.
there's not a lot of agents that just go out and chuck off $50,000. But the bottom line is you're no better off than the guy that just made a $2,000 commission simply because, and he's got a W-2 job to go along with those chunks
Right.
because he can take that money and go invest it and keep living. Where you take 50,000, now you've got to live off of it, and then you have a few little extravagancies here and there and whatever, and then all of a sudden it's gone, and now you're back hunting for the next check. And
Right.
so, the lumpy income, that's what we've always heard it called, I
Right.
guess, really. But so I want to kind of I want to move this discussion towards Wealthword Capital
Sure.
and what you all have to offer. Like you were talking about 3,000 doors
Yeah.
and where they're spread, Dallas, Austin, and San Antonio. And I mean, dude, those are some pretty hot markets, and especially to have that kind of, you say 300 million?
300 million. Yeah. It's the value of the portfolio.
My Lord, man. I mean, that's a pretty heavy, load. I mean, how many folks do you all have working with you?
Well, so it's important to understand that Wealthward Capital, I come in as a general partner. So I would say that, my team, it brought probably, 20% of the capital to that deal, but I actually have two main operating partners that are actually in the deals, operating them as well. But I am truly, my job is really on the capital side, right? Hence, raise masters that we're both in. And so
Yep.
because my focus at Wealthward Capital is I am trying to show people how to build a passive income portfolio in front of them. So,
Yep.
part of this was myself deploying our family's capital. We're always the lead investor. Whatever we bring to our group, we're letting them know how much we're going in, why we're going in, and then we're also reading out to all of our investors, here's the cash flow that we're generating, because we are, to your earlier point, Casey, trying to show them, how do we deploy $1 million of our own capital, and how do we start generating a solid, consistent paycheck with that? Because more than anything, I know that I'm not going to be able to meet all of my investors' needs. They're going to need to invest elsewhere, but I want to show them what a great portfolio looks like, and I want to teach them by showing them.
Yeah, and I've always tried to tell people too. Of course, I don't do much of the teaching, I mean, I want to teach my investors so that they understand
Right.
what we're doing and what we're looking at. But I always preach, boom, preach that capital money needs to be forgotten about. Something only costs $1 million
Yeah.
if it loses value the day you buy it. Now, there's not very many $1 million things that are going to just necessarily. I mean, it might a Lamborghini maybe, and I don't even know that they lose much because
Right.
they're so rare. But what I'm getting at is $1 million is only you're only spending $1 million if it loses money. Now, you are either investing it in
Yeah.
something that's going to benefit you later. So I always try to tell people to not pay attention to the capital money. Pay attention to
Right.
what that money is making you.
That's
Now,
right.
whether that be in cash returns, whether that be in appreciation that maybe you don't see right away, but
Right.
make that money, what it's making you is what it's really worth. So, and so you all have like kind of a fund to fund setup then, really, right?
Well, yeah. I mean, what I'm doing is like I'm always trying to present. I'm the lead LP here. So if you think about it, I'm
Yep.
deploying, and we have syndications. We've also then syndicated. So last year, what happened is, as we've seen apartment yields decrease, starting in 2021, we did
Yeah.
create a fund, and we invested into automated teller machines, right, at ATMs, which are high cash flow, high depreciation. We
Yep.
then have since pivoted heavily into mobile home parks, as you and I were discussing in before the call, where in the mobile home park business, right, it's a growing demand. The demand is off the charts. Supply is shrinking.
Yep.
And there's also significant cash flow there. There's also the opportunity for cash out refis, right? So we
Yep.
want to be able to, provide these. And so we then created a fund that we kicked off last August. We just closed it in March. And then we have, some more offerings we're going to do later this year.
Now, I want to just for the listeners' benefit. I know the answer to this, but I'm going to ask you because I want to hear exactly your angle on it. Let's talk mobile home parks real quick.
Sure.
And we discussed talk about shrinking supply, or talk about maybe you talk about shrinking supply. I guess we could call it shrinking. Although
it is a shrinking supply. It is a shrinking supply because they're not making any more. Because you'll find that a lot of cities, they do not want to add any mobile home parks because of the stigma, not in my backyard. They also, don't generate as much tax as a multifamily building does, but at the same time, it can utilize the same or more services. So they're not making any more. And we're operating right now in Fayetteville, North Carolina. In Fayetteville, there was a very large 100 pad park, and right in front of it, they were building a Class A building. Well, these developers purchased that park to do what? To tear it down and just build a park. So those residents.
So there you go.
Yeah, and so that to me is like because it was not in my backyard. They didn't want to build this Class A building and have the tenants out the back look into a trailer park.
Yeah.
And so
I just don't think a lot of people think that. And like you said, that stigma, which whatever, I've got friends that live everywhere. It doesn't make any difference to me, but stigma that's there, and it is what it is. But the fact of the matter is, you're right. The city councils everywhere, jurisdictions everywhere are saying, no more. We don't want, because you said that you hit the nail on the head. They're not getting as much tax because they're only able to tax that as one piece of property. I'm assuming right. This is probably the logic behind it. It's being taxed as one piece of property. However, you've got, say, 100 families, four right. each. So you've got 400 people that are using 911, the roads, pulling on, I'm trying to think of what other utilities, I don't know, but those should
right. Yeah, ambulance, fire, you name it, any type of services, social services as well.
And they're getting less taxes because it's one property versus being able to tax each of those individuals. They're not
taxing the homes, right? I mean, there's no home tax because
they're going through, because they're titled. So they're going through something else.
Right. And so you'll see that. And the reality is that there's a housing crisis. There is a housing crisis, right? And especially when you think that so let's talk about the stigma, right? There are so many working families right now that they are, working in the lumber mills, they're working in the factories, and they need a safe place to live. They need a safe place to raise their kids. But a $945 one-bedroom apartment, B class, isn't going to cut it because they have 3 children, they have a spouse. And so having a mobile home that provides a nice shelter, gives them a bit of a yard, can be in a community is really important. And, a lot of, the mobile home parks today have been built by another generation who've owned it for 20 or 30 years, tried their best to build communities, but now they're retiring, they want out. And there's a real opportunity for good operators to come in and create and really help sort of plug this housing crisis. And it's not just the families that are of age today. We also have the silver tsunami, right? You have the 10,000 baby boomers that are retiring a day. 50% of them have no savings.
I gotta tell my dad that the silver tsunami. I've never heard
silver tsunami. Yeah,
I need to get him on the phone, and I've never heard it called. I'm sure if there's listeners out there have heard it called the silver tsunami. Please.
Oh gosh. It's happening.
That's awesome.
So, no, and they need places too. And guess what? They want a safe, affordable place where they can also be in a community. And so it really solves a problem. The reality is too, though, there are some. We know in Fayetteville where we operate, there are 400 mobile home parks, maybe minus that one that just got tore down. So 399.
Sure.
But, there are areas that have a lot of density, and there still is a buying opportunity here.
Wow. Well, I'll tell you, that's just all in all going to be interesting to watch and see, as some of these things kind of, I guess that they're grandfathered in, and of course that's going to be dependent upon each individual jurisdiction or whatever, but it's going to be interesting to see how all of this plays out. Now, just real quick before we jump off here, you were talking about in Florida, and I just go back to the silver tsunami.
Yeah.
A lot of those places are real low maintenance too. I mean, they if they have somewhere, if they can live somewhere where all of that stuff is taken care of, and like you said, they have the communities. But if the people that started or are running those communities,
Yeah.
are beginning to turn them over, I mean, that you could definitely see that housing crisis increase if they start saying, "Hey, we don't want to do this anymore," or something along those lines.
Well,
So,
and this is, to me, is where there's the business opportunity, right, for good operators.
yeah, sure. Well, Christopher, listen, I always end the show by letting people give their contact info out and tell people how they can reach out to you. But first of all, I want to thank you so much for your time. I know it's hard for people, especially somebody that's managing that kind of money and that kind of investor base and whatever that you've got involved there. It's hard to come up with the time to do these things, but I certainly do appreciate it from the bottom of my heart. I appreciate you taking the time to be here. So if you would, why don't you tell the listeners how they can reach out to you? They might want to make an investment with you. They might want to pick your brain about maybe a mobile home park, or even if they've got some questions about coming to Austin or something,
There you go.
How can the listeners reach out to you?
Well, if they are interested in mobile home parks, we do have an offering. It's thrivecommunity.fund. We'll make sure and put that in the show notes, Casey. But thrivecommunity.fund is they can learn more about our mobile home park offerings, and go in there and they'll get a free webinar, and they can learn about what we're doing, meet the operators, and have a good time. And then if you want to know more about Wealthword, and because we still do some transactions here in Central Texas when it comes to multifamily, like still on the table, they can go to Wealthword, like that's WEALTHWARD, Wealthword, moving you towards wealth, wealthword.com. Come there, and if you want to get in contact, there's a contact page, and I'll be happy to take a meeting and have a chat.
Awesome, man. Well, Christopher, again, thank you so much. I really appreciate it. And we hope everybody has a wonderful rest of the day. And thank you for listening to your daily investment podcast. Thank you.
Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.